Okay, good morning and happy Tuesday, and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and markets are pretty much continuing what we've been talking about for the last couple of months now, where basically we are somewhat in silly season. We have the same metrics that we're taking a look at. So today what we're going to do is we're going to take a little bit of a step back and take a look at the big picture and put into context where we currently are trading, because a lot of investors have been asking us the same question over the past couple of weeks as far as how far can markets continue to move higher. So today I want to try to answer some of those questions. Now, before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we want to do is we want to always start off with a broader market update as far as where the major indices are trading. We don't want to talk again about how the market health here has continued to decline. But again, that decline in terms of market health is always still balanced with quite a few bullish factors that we are looking at. So at this point, our thesis or base case still remains the fact that despite the issues that we see in the market, there's no indicator that signifies that it's time to start looking at short positions, that it's better to stay the course with this bullish move. Now, things can change very quickly, so we want to make sure that we keep you updated on this front, but as of right now, that's what we currently see. There are some movements right now in the dollar and rates. That's really where we're focusing a lot of our attention on right now as far as ideas, because the fixed income market is reacting while the equity markets are not. So we want to take a look at what's currently going on in the fixed income markets and where do we see some opportunities. Then we want to share with you some of our economic data and the current ideas that we are currently looking at. If we have a few minutes at the end, we'll try to answer some questions. So the primary question, and I think investors have shifted a little bit here over the past couple of weeks. You know, when we were talking here 3-4 weeks ago, the predominant question was, how do I short this market? How do I protect my portfolio? Now the narrative has changed a little bit. The question is now, I think a lot of shorts have actually been squeezed out. A lot of people that have been buying puts have seen them expire worthless. A lot of hedges have gone fairly expensive hedges have gone nowhere. So a lot of investors are now asking, should I continue to buy this dip and stay long in this market? And that, again, is our primary base case. So we're going to try to help answer that question. Now, today, what I'm going to do is share with you my charts, some of the economic research that I'm currently looking at to determine my views and my ideas here in the market. So what I want to do is I want to start off without looking at any charts and taking a look at the big picture. And what we want to see was the average bear market, the average corresponding bull market after that bear market, and roughly how far markets can actually move after they recover their prior highs. So if we go all the way back to 1929, including the Great Depression, what we see is that the median bear market decline was roughly 33%. 33% was the average, was the median bear market. Now, from February to March, that's exactly what we saw, was about a 33% decline in the markets. Now, subsequently, after a bear market, the median move after that is about 50%. Meaning the markets recover about 50% to get back to break even. And as you can see, that's exactly what we saw this time. After a 33% decline, we've seen a 51% move to get back to its 52-week high. Now, the number that I actually want to focus on today is after a bear market, after the market recovers its bear market, meaning gets back to its prior high, how far do equity markets typically continue that move after it's reclaimed its recent high? And the answer to that question is actually probably surprisingly higher than you might think. The median gain beyond a prior peak, which is this column, is actually 46%. So imagine equity markets being another roughly 40% higher from where we are currently trading. That puts the S&P 500 significantly higher than where we're trading. And I think for many investors that are asking the question here over the past couple of months, how far can this go? If you go back from a seasonality perspective, the answer is substantially higher. The average is actually 96% higher, and the minimum, meaning the smallest rally since the high, is actually 11%, which is still a little bit higher than where we're currently sitting. The maximum is 356. Now, I don't want to focus too much on the maximum, but the minimum and the median is where I want to focus on. And what that projects out is a fairly still substantial move here to the upside, around 375 to the upside on SPY, all the way into the 400s, if we're looking at a 46% continuation higher. Now, you can't just take these, it's a very small sample size to begin with, so you don't want to put a lot of weight behind it, but this gives you a sense for, how far equity markets can and historically have gone, after these types of boom and bust cycles. So this is the big picture that I want to help put into context, because sometimes when we're trading day to day and we're trading week to week, we lose sight of sometimes the big picture, and sometimes it's good to take a step back and just understand where we're currently trading. So that's what I want to start off with. And with that, let's look at the S&P 500. Now, not much has changed since we spoke last week. We continue to push higher here on the S&P, slow grind higher as always day to day. We still have this massive divergence here on the weekly chart. The daily chart has resolved its negative divergence, and as markets continue to make higher highs, momentum is confirming those highs. We have strong money flow on both the daily and weekly charts. So our base case remains, when you have that dip, and many times these types of dips that we're seeing are very small. You're seeing dips that only last a couple of trading days. It barely touches the 20-day moving average. Sometimes it doesn't even get to it, and then it continues to grind higher. So perhaps another dip and a continuation higher. There's just no other indicators right now that suggest that this is ending and that you're going to get at this crash that a lot of, I would say, investors are almost hoping for. And I'm not, and it's simply, I think most investors are looking for that simply because the market rally here doesn't make a lot of sense. So I do want to show you some of the economic research, some of the economic data to understand, how equity markets are continuing to move higher. Those are some of the things I want to show you here today. Now, the Nasdaq 100, similar story. What we have is a very, very steady continuation climb higher. The Nasdaq 100 has predominantly has continued to pull back to the 20-day moving average, and those have been buying opportunities. But over the last couple of weeks has continued to get stretched even further. Now, we did talk about this negative divergence here as markets continue to move higher here over the past couple of months. The momentum has not confirmed those moves higher, but the recent push higher has broken that, and we've now reconfirmed that continuation higher. And momentum indicators are now severely overbought. What that does imply is a short-term potential pullback to that 20-day moving average before a continuation higher. But again, similar to the S&P 500, daily money flow, weekly money flow remaining very strong. Now, if we look at the S&P 500 and the Nasdaq 100 index, we see that they have reclaimed their recent highs, meaning their February highs, and they're now continuing to push higher. And again, that big picture seasonality chart that we were showing you before shows that it is possible for markets to continue to be in this state for a fair amount of time, or at least substantially higher than where we're currently trading. However, there are some concerns that we see. These are the same concerns that we've been talking about for the past almost month and a half now, which is the fact that the broader market is no longer keeping up with this rally. Normally, for a market rally to be healthy, what you want to see is a fair amount of healthy sector rotation, and you want to see the broader market keep up with these gains. And what we have started to see here over the past couple of months is really this is starting to deteriorate. So when we talk about the health of the market, this is what we're referring to. Small caps no longer keeping up with the market. Small caps well behind its February highs of around 170. It is below its all-time highs in the 173, 172, 173 range. So those are still major resistance level here on the small caps. Small caps has, at least for the most part, held this 153 level here, which is after breaking out above it, but it stays below that 160 level. I am looking for a potential breakout here above this 160 level here in small caps because we are seeing momentum indicators confirming these moves higher. However, one of the concerns is the fact that I think it's going to be difficult for small caps to get above this 170, 173 level. So this is this bearish divergence that we're currently seeing in the markets. That is some of the warning signs that we're seeing. Not only is small caps not keeping up, but the equal weight indices are also not keeping up. What this is telling us is that the broader market, that the majority of stocks in the market is not actually keeping up with these gains, that it's just smaller percentage of stocks, meaning the tech stocks, they're dragging this market higher, and the vast majority of stocks are actually being left behind. When we look at the equal weight indices has made no progress here, almost no progress over the past 2 months. It has barely moved up about less than 5 percentage points over the past 2 months, while equity markets have gone nothing but straight up in terms of the market cap indices, the S&P and the Nasdaq 100 index. And it's still, at this point, is still below this June 5th high of around 113 or so. So can this see a breakout? Certainly can, but again, the backdrop here is significantly weaker here. So when you couple this with the fact that we are continuing to see just two sectors pretty much dominate this market, which is technology and consumer discretionary. This is the same type of lack of sector rotation that we saw from January to February of 2020, right before the coronavirus sell-off. Now, how do we know what is the next catalyst that's going to trigger this next sell-off? The answer is we don't know. That's the thing. But what we can do is we can look at the warning signs, we can be prepared for it, and that's exactly what we're advocating here. Is in this type of market, the only way to truly continue to play for upside, but do so in a way where you are protected to the downside, is not buying puts on your portfolio, but to buy call options on the stocks that you think are going to continue moving higher in the technology space, in the consumer discretionary space. Buy those call options, and as the stocks move higher, roll those call options higher and higher and higher. Keep taking profits on those, so that if the market drops, and that can happen tomorrow, the catalyst that actually triggers the next sell-off could happen tomorrow, it could happen next month, it could happen 2 years from today. Unfortunately, there's just no way for us to predict the future from this perspective. But what you can do is position yourself correctly for this type of market environment. So that is what we're advocating for here in this particular market. Now, what we have seen is inflation expectations continue to rise here over the past couple of months. And we're starting to see, we've talked about this decline in the US dollar. We talked about this breakdown below the $96 range. This was in June. We talked about the breakdown. We saw a consolidation here for the past few weeks, and now we're seeing that breakdown continue lower. So now I expect this dollar to really resume its move lower here. And this is really where some of the opportunities that we see. Whether you're invested in gold and silver, we've seen some moves in that. We talked about the move in silver last week. We've seen another, after about a 3-week consolidation in both gold and silver, we're now starting to see silver break out to the upside again. For those of you that trade currencies or you have some ideas also here in the dollar that allow you to trade some currencies, for those of you, I know we haven't traveled in a while, but for those of you that were traveling, the euro, dollar, British pound, Australian dollar, those are really weak against the dollar, but we're starting to see strength in those. So traveling abroad for Americans is going to get a little bit more expensive. So those are some of the trades that we're starting to see emerge from these markets as potential opportunities. If you're uncomfortable chasing those tech names higher, you're concerned about where the markets are trading. These are some alternative opportunities that we're currently seeing in the market as a result of these moves that we've seen in the dollar. Now, the VIX and the VXN, so the VIX indicator for the S&P 500 and the volatility index for the Nasdaq 100 index, have seen significant moves to the upside, meaning higher amounts of elevated volatility, higher amounts of uncertainty, despite equity markets continue to claim or move to all-time highs. These are another sign of warning signs that we're currently seeing. that not everything is functioning okay here in this market, as market participants are starting to be a little bit more fearful, especially as we start getting into election territory and we start paying attention to some of the probability indicators as far as who's going to win both Congress and the presidency. These are some of the things that are going to start being at play here over the next couple of months. So, pay attention here to the volatility indices and how they're currently reacting to this market. Now, like I said, we've seen inflation expectations rise here over the past couple of months, and Fed's policy, the Federal Reserve's policy last week has effectively committed them to keeping rates low for the long term, which will potentially set inflation numbers higher above the regular 2% target, meaning historically, the Fed's policy was that once inflation got above 2%, they were going to start raising rates. But now what they've basically committed to is even if inflation gets above 2%, they intend on keeping rates low for the long term. What that does is it distorts the yield curve. It distorts the shorter end of the curve, where the Fed is keeping the short end of the curve near or at zero, while the long end of the curve, which is more based on market forces, are being sold off right now because of this uptick in inflation expectations. Because when yields are at 50, 60 basis points and it's not keeping up with inflation, that's going to be less attractive for those longer term bonds. And we've seen the sell-off here in bonds. So if we look at the TLT, which is the long-term bonds, 20-year plus bonds, we had this massive double top here. And what we've seen is a significant decline since then. Now, if we look at the long-term weekly chart, it's still, as we can see historically, we've seen breakdowns to the 20-week moving average before it confirms higher. What we've had another pullback here is below the 20-week moving average. And the question right now is, does this continue moving higher back into that 172 level, or is this the beginning of a larger term structural pullback? Now, as you can see here, over the past couple of weeks, money flow has gone negative. Momentum has clearly slowed down and started to move to the downside. So my hunch here is that this will likely to continue moving lower here. So these are some of the opportunities that we see in the markets from the treasury markets outside of equities. So TLT 172 double top here. The question is whether we see a continuation lower, at least into the 200-day moving average here on TLT, which is in the 156 range or so, right now trading around 162. Do we see a continuation down here? So those are some of the opportunities that we see in the market from the rates market. So I did want to take a look at some of the economic numbers, because we have a big one coming out this Friday, which is non-farm payroll and unemployment. We do at this point expect that those job numbers will come out fairly strong. This is an economic number that the markets have reacted fairly strongly to over the past few months, because the numbers have consistently come out slightly better than expectation, and we've seen this growth in terms of number of jobs added. So right now the projection is about 1.4 million jobs added in August. So we'll see on Friday whether the actual numbers exceed this or come in below this. And with that 1.4 million jobs created, our expectation is that the unemployment rate will fall below 10%. That's the consensus. If the market beats that, or if the economic numbers beat that, we'll likely see the markets react positively to that, and that would likely push that market continuously higher, the broader market. And if we look at some of the other economic indicators, and this is really where we continue to see surprises here to the upside. So the survey for the Dallas Fed manufacturing index was the expectation of 0, but the actual number came out at 8. So back into expansion territory. So we're continuing to see economic surprise from manufacturing, from services, from employment numbers coming out better than than consensus. And again, this is part of the forward-looking nature of equity markets, and how they're continuing to move forward here and move higher is something on the back of some of these economic numbers. So some of the ideas we want to share with you. It's difficult not to look at names like Tesla and Apple and Zoom and feel left out sometimes if you weren't in some of those names, or felt that maybe you sold some of that recently and you see these markets continue to move higher. So we do want to show you some of the tech names that are built on better balance sheets that have, maybe a slightly less upside than the names like CRM and Tesla, but are seeing some pauses in their rally. So what we always advocate in this type of market environment is don't chase these highs. What we have are plenty of opportunities for pullbacks here. And that's exactly what we're seeing here in the short run here for the past 3 days in Facebook. While equity markets continue to move higher, those are the opportunities that we want to seek to continue to go long. So Facebook, broke out above 300, came back to consolidate here for the past few days, and looks like it could be primed for a continuation higher, especially on the back of the strength that we've seen in Apple and Tesla and the broader Nasdaq 100 index. Facebook is naturally going to be have a tailwind from this. So some of the opportunities that we see in tech are in names like Facebook that have a much more, I would say, better business model, built on profitability, and actually has some gains here to the upside after a brief pause. Another sector that we've continuously looked at is consumer discretionary, which is between technology and consumer discretionary. These are the only two sectors that are beating the S&P 500. Everything else has fallen behind or just barely keeping pace right now. Communications just barely keeping pace, but still at this point beating the S&P 500. I was taking a look at eBay within this particular category because eBay over the past couple of months has made no progress and consolidated here. And while eBay certainly was a name that came out of nowhere as a result of the coronavirus, but what we've had is a very strong move to the upside. We've had a consolidation, and what we're looking for is a continuation. And this could continue on substantially longer here. So the potential reward here is, in my opinion, very attractive compared to the amount of risk, because we're sitting just at that support level. If instead this stock declines to, let's say, the 52.50 range, we're only risking here about less than 6-7% of the underlying stock price to potentially make what I see is a substantial amount of upside here after such a strong rally. So this is the type of setup that I'm typically looking for from a technical analysis perspective, where you have a long move to the upside, a consolidation range, and what you're looking for is a breakout higher. Now, the risk to reward ratio here is very strong here, meaning you can put on a trade like this using a call spread, risking only about 6-7% of the underlying stock price to play for substantially bigger upside here if eBay does break out back above that $60 level, which, as the market continues to march higher, that is a possibility. Another one that we want to point you to is XRT. This is one that, is the retail ETF, which arguably is one of the weaker sectors, but as you can see, XRT is showing a lot of strength and actually revisiting its September 2018 highs. So the fact that it's revisiting those 2018 highs and potentially, and especially when we get a short-term pullback here back to the 20-day moving average, that could be the coiling that it needs to continue to break out here. So this is a breakout candidate here. I don't think it's necessarily the right time to get in immediately, but this is one that I would put on my watch list. Look for that breakout above that $52 level. And if we do get that breakout and we start to see some acceleration to the upside, I think there's far more room to the upside. This is one that I would be a little bit more conservative on and wait for the actual breakout before going long, rather than trying to play for that breakout here, in my opinion, just because it is a sector that is, or an industry rather, that is on the decline. And lastly, I did want to take a look at the euro. So like I said, for those of us that travel abroad, for a long time, euro was under 115, 110. It is now back near 120. Now, like I said, with the dollar declining, this is really where we see more of a structural shift, a long-term shift in the euro. So the euro has had a multi-year decline. Now, this bearish trend line has now been broken here to the upside. We've had multiple confirmations of this break here. We had one false break, earlier during the coronavirus sell-off, but we've now had a true break here, and we've now broken above the 200-week moving average, and now we've had a consistent move here to the upside. We've also had this, if you want to call this a few waves, and then now we've gotten this consolidation range, and looks like it's starting to break out here to the upside again. So FXE. the ETF that tracks the Euro USD exchange rate. Not on everyone's radar, but this is one that we are seeing a lot of institutional flow into this type of play here. So using options to play for a further decline in the dollar and strengthening here of the euro are some of the ideas that we want to take a look at. So with that, that covers what I wanted to share with you here today, how I'm viewing the markets from a macro perspective, what economic research that I'm currently paying attention to, and the ideas that I'm currently looking at here with the markets. I hope that this was helpful in giving you guys a better understanding as to how to position here for the markets. So thank you so much for your time this morning, and I'll see you guys here on next Tuesday. Have a great day.